And Stephen, who manages just over almost $7 billion at Windhaven, which was acquired by Schwab late last year. Stephen, first of all, I know you're a longer-term guy, but I want to get you to weigh in on what's been happening, not only in the markets today, but in the past few days, following the signing of this debt deal. It seems like we're getting whipsawed all over the place. Are investors still just trying to figure out where we go from here, considering the economic data, considering the debt deal?
Investors are especially confused right now, I find. On one hand, they're so fearful that they're willing to buy Treasury bills earning just about zero. And on the other hand, they're willing to buy internet IPOs of enormous multiples of revenue. So there's a lot of confusion there. And then with the debt ceiling, a lot of fear and panic. People are remembering what happened in 2008 and feeling that trauma, almost like an aftershock after an earthquake. And so we have seen tremendous uncertainty, and it's all the more important why people should be globally diversified across asset classes.
Well, and I know underlying the numbers, or underlying sort of that hype that we've been seeing, you've been looking at the numbers for things like GDP, for the various inflation indicators. And you're actually concerned about stagflation, which is stagnant growth with rising inflation. That's something that has come up here and there over the past year or so.
That's right. And we've been concerned for some time, and we've been positioning our portfolios exactly for that scenario. You have a situation where we've had massive debt that needs to be deleveraged now, and it's at all the corporate, all the government levels. And that tends to generate a lot of slow growth, especially if debt to GDP ratios get over 90%. And so the way we positioned about that is that if you can't rely on fiscal stimulus, you have to rely on monetary stimulus. We already have extraordinarily low real interest rates, negative real interest rates. And so what that says is, in combination with the slow growth, we're going to have weaker paper currencies. So that means people should be positioned in gold, in long tips, in fixed income, in other markets like non-Japan Asian local currency debt. And we find that these have been really helping stabilize the portfolios.
And we should mention, by the way, that you invest through ETFs when you're looking at these various assets. Let's talk about gold for a minute, because this has been hitting record after record as the crisis had continued, and then on concern about slowing economic growth. Is there a ceiling here that we're going to hit at some point?
Well, certainly in the short term, we've had such a run up that it would be natural to expect some kind of profit correction. But we're still in a situation where the Fed has negative real interest rates that are extraordinarily low, almost unprecedented, and I don't see that changing in any short term. Unless we had a massive change in Fed policy, I don't see a big change. Also, over long periods of time, gold tends to appreciate at the rate of the monetary base. And if we were to get back to the gold standard today, which I don't think politically is possible, but if we were, based on some very rough analysis, we would need to price gold at over $5,000 an ounce just to be able to back all of the paper dollars that have been printed with the gold supply. So the only natural ceiling is how weak can the dollar get, because we think of gold price as not reflecting the value of gold, but reflecting the value of the paper currency that it's priced in.
Stephen, unfortunately, we're out of time, but thank you so much for coming in to talk to us. Stephen Cucchiaro of Windhaven Investment Management.